Are you ready to bring your real estate game to the next level? My name is James Prendamano. I'm the CEO and founder of PreReal. And over the past 25 years, I've closed over $1 billion in transactional real estate. Each week, I'm meeting with outstanding investors, high-performing individuals, and visionaries operating in the real estate space. These are the people that are actually out there in the real estate game right now getting it done. This podcast aims at bringing anyone's game to the next level. This is the PreReal Podcast. Welcome, everyone, to the Prendamano Podcast. We have Steffany Boldrini joining us today. Steffany is the principal of Monte Carlo Real Estate Investments. She's got a great story, and it's again, good timing here. Steffany is got an amazing podcast. It's called the Commercial Real Estate Investing from A to Z Podcast. For those of you that are always looking for tips and tricks, it's packed with information, great guests. Definitely would give it a try. Steph, thanks for joining us today.
Thank you so much for having me, James. I appreciate it.
No, it's our pleasure. So, I thought it would be fun to talk a little bit about your beginnings, right? You were born and raised on a small ranch in Brazil. Is that correct?
That is right.
So, without giving us a 3-hour history, how do you get from a small ranch in Brazil to running an investment company and preparing for scale?
It's a blessing to be here. So I always like to thank God for it. But my parents decided to come here, and we came here about 20 years ago, landed in Silicon Valley and started working in tech just by the nature of just living here. And decided to start investing in real estate because I had my boyfriend at the time that was a very successful real estate investor. And it was very clear that real estate is, at that point, I was interested in angel investing. It's a much better form of investment compared to angel investing.
So, well, I have to press you on you were involved in tech. I mean, you were involved in tech and from what I understand, one of the startups went public and was traded for like 20 billion or is worth over $20 billion.
Yeah, right now I think they're at 50. So good for
50
them.
billion. So during that time in the tech space, what was your work centered around?
Sales. Always sales. Mm-hmm.
And was it tech for what industry?
For other tech companies, so anyone that has a website and is scaling those websites, but also enterprise companies, like Salesforce, Cisco, and things like that.
Got it. So you get the real estate bug, and you decide that this is something you want to pursue. Let's talk, I guess, about that initial journey. Your first deal. I mean, your first official interaction outside of affiliation. How did you actually land in the game?
Yeah, great question. So, was with that person at the time, so decided to take as many notes as I possibly could and learn as much as possible. And it did take me a couple of years to finally end up buying my first couple of properties. And it was some car washes. And it was just a very humbling experience. But the numbers work out so far really well. But at this point, at that point, I did not know anything about car washes. What I learned was all in the retail space. And I'm like, how hard could it be to learn about car washes? And there are literally more than 100 moving parts, SKUs, and anything that you can and cannot imagine that can happen. But the numbers made sense because I was well trained by my mentor to, how to negotiate and how to analyze a property for upside and adding value and things like that.
Okay, so you acquired real estate that had leases for car washes, or did you actually acquire real estate
Both.
And the business?
Both.
Oh, so
yeah. So I'm running.
There's a big difference there. All right, so
it's been a journey, James.
Now I understand. Okay, so it's not that Steffany decided, hey, I'm going to go buy my first piece of real estate. She decided I was going to buy a piece of real estate with a living business on it that you were the owner of at this point.
Yeah, which, at the end of the day, a lot of them are actual businesses. I think self-storage would qualify as a business. I think multifamily would qualify as a business. So I think industrial, retail, and office are the ones that are more really, once you negotiate and sign the leases is more mailbox money, but everything else, you need to have a manager on site. You need to collect rent and other things. And so I think there are a few asset classes out there that are actual businesses.
Yeah, I would agree. In today's world, Steffany, we hear all the time, and you see all the glitz and the glamour and the great parts about real estate, right? And everybody wants to be a real estate investor, and everyone's trading in the 9 to 5 to be an entrepreneur. But what you don't see is the other side of it, the sacrifice, the stress, and sometimes these really sharp learning curves that you have to adapt, and you have to pivot in many instances, because industry now, any business that you buy, I don't care what sector it's in in the midst of significant disruption, significant change. And I agree that there are certain asset classes like self-storage where you are absolutely running a business. But a car wash, I mean, that for me, at least on its surface, would appear to be an entirely different discipline, right? There's mechanical components. Of course, there's the web presence and trying to grow the business and organic and all of those things that you need to do in the digital world. Wow. So you're still in those deals now?
Still, yes.
Okay. And that was your first acquisition.
Yes.
Right.
Yes. So it cannot get worse than this. Trust me.
Yeah. So you make this acquisition, you have a sharp learning curve, you're enjoying it. Outside of the pain, of course, of the learning curve, you're enjoying it. But what was it that, once things settled down, what was it that triggered and had you say, you know what, I this is what I want to do. I want to go take down commercial real estate and build a portfolio?
Oh, because real estate, I heard a friend, a very successful syndicator friend of mine, who said 90% of all wealth created for the last 100 years was through real estate. And today we can all see with our own eyes that things are inflating significantly. And real estate will just continue. It's just a trend. And even where I live, for at least the last 70 years that I know people that have been here, every time it's crazy. It cannot get higher than this, even in the 70s or the 50s, right? So back then they were like, oh my gosh, how can you pay $50,000 for a home here? Last year it was, on average home 1.5, and today in the same areas 2. So it's just, we just have to, otherwise we're just losing money in our savings account every single day through inflation.
So I agree wholeheartedly. And for those of you that didn't catch that last little bit of absolute wisdom, as inflation hits, and we've talked about this with fixed income assets, even though you're collecting rent and even though you may be collecting a small margin in the bank, you are absolutely losing money, as the cost of goods is far outpacing those offsets. And I think even the most bullish real estate assets in short order are going to be challenged to keep up with inflation and with what's ahead. So, you talked about how, and I remember this. I remember so clearly when I first started in real estate. There's a town out here called Westerly, a very nice residential town, and the homes were trading 150, 155,000, detached 3-bedroom, 4-bedroom homes. And I'll never forget, one of the brokers had listed a house in Westerly for 170,000. And I remember thinking, what a fool. Who would ever pay $170,000 for a home in Westerly? Fast forward 20, 25 years, you can't touch anything for less than 600,000, 700,000 in Westerly, right? But it's not all lollipops and sunshine in real estate either. There's an ebb and a flow to this thing, and there's a cycle, and there are market shifts. So I was wondering, as you're analyzing where to make your next play, and you're debating which asset classes offer the most upside, are you contemplating, what we've been calling now for 10 years, the decentralization of real estate from the major cities? Is that factoring into your decisioning?
Absolutely. As so long as there is a great, obviously population growth, diverse economy, different industries there, we don't care as long as it's, at least, let's say 150,000 population or within a metro area. So, and in today's world, I think that diversification is important, for that next cycle. And, there's two different thoughts for, but some people want to focus on a specific asset class. Today, I think it's important to diversify. Once something hits the fan within the next few years, at least some of your asset classes should, maintain its value and continue to be stable versus everything coming down, like, some office in some metro areas are going through right now. So that's just my train of thought today.
So it is so refreshing to hear somebody recognize that it is going to hit the fan in the next few years. So
I hope people are recognizing that.
No, what's happening now, Steph, is the more and more people we're talking to, they're falling into the trap of buying a payment, right? They're looking at these super attractive rates, and they're looking at these secondary markets and tertiary markets that are emerging, and they're so drawn in by the low buy-in because of the interest rate and the robust rental at this point, that they're not contemplating, okay, but what's next, right? For those of us who've been in the business long enough, we understand 95% occupancy is not the norm, and you do have serious stretches, years and years, where those occupancies roll back, and as occupancy rolls back, rents drop, and as rent drops, you have to be more competitive and invest more in your asset to make it more attractive. But folks are not looking at that as vigilantly as I think we should be. I'm a pretty big believer in 2024. I think second or third quarter of 2024 into 2025, we're gonna be in for a rough stretch here for a number of different reasons. What are you forecasting? What do you see?
As my mentor likes to say, I've been forecasting the next downturn since 2016. So I'm the last person that will know these things. I thought last year would have been a disaster, sold a lot of stocks, sadly. Everything quadrupled because the government printed so much money. How can we predict? Sadly, I'm not in that position. I do not know. So
none of us know, right? And we certainly can't pretend that we know, but we can venture our best guesses. So, what we're seeing is as people are buying these payments, the institutional money, the big money, is still on the sidelines. Like the big banks, they're not lending. And what's happening is these opportunity funds or these mid-market funds, they're filling that gap, and bridge money that was 10 and 11% is now 7%. And it's creating, it's close enough to where the institutional rates were, at least, to keep this thing moving forward, but it's all short-term money. None of this is 10, 15, 20-year money. It's all short-term money. And when that money comes due and those notes come due, somebody's got to be there to knock them back out and refinance them. And I think that's where we're going to run into some trouble. So as we can't continue to print money in perpetuity. I think that the feeling out there is people are now starting to, everyone at first loves the idea of printing money, right? Checks are coming in and everybody feels good. And, we're buying Reeboks and watches when we should be buying real estate. and people feel good about it, but that starts to catch up when you see it at the consumer level, when you see the price at the pump going up and the price of milk going up and the price of eggs going up. That's when people start to pull back. And I think that we're starting to have that feeling in the country now, and that will eventually translate into new policy, and that will slow down. And when it does slow down, hold on to your hats, folks, because I think it's going to be an interesting time. But if you're well positioned and you keep some powder dry, I think you'll be able to do a lot of damage during that time as well. So
Always.
let's forget about the future then. Let's talk about now. What asset classes are you bullish in?
Definitely self-storage. Maybe car washes. I still haven't decided if I would do another one again, but there are a lot of ways to add value in car washes. But definitely self-storage. It has been proven over and over again that it is recession resistant, even last year. And recently, short-term rentals, these numbers look great, depending on where you buy. And everyone that is doing short-term rental is very happy, everyone that I know. And their returns are pretty incredible.
So self-storage, again, you're not buying like a stabilized portfolio where national tenants are occupying and paying a lease. You're actually buying the business.
Correct. Yes.
Okay. And on the short-term rentals, are we talking about like Airbnbs, that portfolio? Okay.
Yes.
So short-term rentals now make a lot of sense as inflation creeps up, right? It was the holy grail, at least out here, was those longer term commercial leases that had, decent paper behind them. And if you had built yourself in 2% or 10% every 5, or if you were lucky, 3% annual increases, you felt real good about it.
Yeah.
But again, as inflation creeps in, absent some sort of CPI reset on those leases, which is very difficult to get, we're technically facing a period where, while the rents may be coming in and the debt services coverage is covered, we're still actually losing money in those assets year over year. Yeah, even with 3% increases. So are you staying away from the long-term leases completely?
Yes. Yeah. I never wanted to ever even dab into multifamily, and just came into short-term because a friend of mine told me the numbers, and I said, wow, those are incredible numbers. And so I'm just dabbing on my first couple right now for fun.
So would you feel comfortable sharing what numbers you're seeing, what kind of returns you're seeing?
Absolutely. So just did the math my first purchase was 4 months ago, and so far is a 30% cash on cash, wow, including all the furniture and everything else.
And what type of asset was that?
A single family.
Okay, and now you're enjoying some success here, a lot of success here, as our eyes get wide, as they tend to do, right? What's next for Steffany on the horizon? What are you looking to step into next?
Yeah, just I'm analyzing always self-storage facilities where there is some upside there for increasing rents or building new units. So that has been my focus over the last several months.
And you're looking to scale?
Yes, definitely. Mm-hmm.
Okay, so do you have any plans for that? Any ideas of an offering or what that would look like?
An actual property, we have not identified a property today. We're always analyzing whatever is available. So when that happens, we're going to potentially do a syndication depending on how large the deal is.
Okay, so I think it may make sense for us to talk through the differences for some of the folks out there of a syndication versus doing like a traditional raise. So my sense is, Steffany, that you're going to identify the next asset at scale price-wise, right? So the idea is to step it up in class for strike price, and then is it a friends and family raise, or what type of a raise are you going to target?
Probably friends and family, because people have been knowing that I've been doing this for a while now, and quite a few people reached out saying, "Hey, when you have a deal, let me know." So hopefully, I'll be able to raise the whole thing through friends and family.
Sounds good. So, can you tell the audience a little bit about Monte Carlo real estate? How exactly did it, like, what was the genesis? How did it start?
Well, I just wanted to do something on my own and decided to leave the sales life and started this investment firm. And at some point, we're going to start doing syndications. I wanted to do a few deals on my own to show people that, we can make these numbers are great, and here they are. It's not just, oh, I don't have any experience and just give me some money. So that was the goal. At some point, scale through syndications.
How many deals have you taken down to this point?
It's around 5, 6, 7, more or less.
And are you investing in just a local market, or are you bouncing around?
Right now, remotely. So I'm investing in Texas right now.
In Texas.
Mm-hmm.
So when you're identifying a market to invest in, I think that's another challenge that the digital world has given us the tools to connect in a real meaningful way to these submarkets. But there's something about being able to touch and feel the investment and not being able to touch and feel the investment, right? Having boots on the ground or not having boots on the ground.
Yeah.
So are there any particular metrics that you're looking at when you're considering an MSA?
Well, population growth, different industries, strong, a business sense. Unlike California, Texas, Florida, and a few other states are very business friendly. And yeah, those are the major things that come to mind. But team is always so important. So that's one thing that I would always recommend. Is it just a blue collar city? Because that will become very difficult for you to get professional people to work for you. Obviously not impossible, but it just becomes harder. So these are some of the things you should be thinking about, talking from experience.
So are you using like a secret sauce? Are you, looking at different metrics and using, of course, some of just your innate ability to size up a market and size up a deal? Or is there any particular software or programs that you're looking at when you're contemplating a different market?
I'm not using software right now. I just do some Google searches. I talk to people. I know quite a few people in the real estate field. And there are some websites out there that you can find what, I really forgot the name, but it's like what kind of industries are in that city. It's all freely available to anybody. I do not have a specific software that I use. I had found a phenomenal company before, but they're no longer doing this type of business. But I'm sure there are other ones out there where they tell you which home you should buy based on so many other metrics within a specific city. So they look at even, people's Instagrams, how many blue French bulldogs are being posted on Instagram in this area, how many scooters or bird scooters are, in this area. And they used to find lower priced homes in really good up and coming areas, but they're not doing that right now. But I'm sure there are other websites that are starting to do that at this point.
So something that, again, we've been talking about, and I heard you hit on it a little earlier, legislative threats. That might be the single largest driving factor for us, is what type of legislation is on the horizon, what type of legislation are they currently passing, because it is having a profound impact on investment strategies up here in the Northeast, a profound impact. You're seeing the same in California?
Oh, yeah. California is not business friendly at all. But, there are obviously a lot of very successful people that work around these things, or they know, what they should be focusing on. I have not learned, how to add value in a multifamily property in California when you have rent control and a few other things. You cannot kick people out, you know, and so it's just what you want to focus on. And there are obviously always ways to add value, but, things can come along that can completely destroy your business. Like there was a proposition to for the property taxes to become current pricing, but instead of what you paid for commercial. That will kill. I heard a particular winery was saying we're going to be dead if this passes. We cannot afford a new tax base if that regulation passes. And they're not the only one. There are so many other people that own these buildings for several years that are paying a lower tax base.
So it's not for the audience. It's not about a cold or a callous strategy. It's about, in these bigger cities, the reason that investors hang in and the reason that they stick around is plain and simple. It comes down to the opportunity and the rate of return, right? And
Yep.
What's happened, unfortunately, is the pendulum has swung so far back that opportunity is waning, and the risk just is now outweighing the potential upside of investing here in New York. And we're excited that there's new leadership, new governor that seems to be saying all the right things, and we know they have a great team around them that we're very bullish on, and a new mayor inbound in New York City. We're hoping that we see a shift in some of the policies. For example, the opportunity zone is a great vehicle to defer taxes, spur investment, and enter into new markets. So in New York, they passed legislation decoupling from the federal benefit. So if you put money into a QOZB and you were making an investment here, just like that, they decoupled from the federal benefit, and you no longer get the deferment benefit on your taxes. So what's happened is, because the opportunity zone is very flexible, the rules are, it's not like a 1031 exchange. It doesn't go to an escrow agent. You have control over your own money. There's a lot more flexibility and freedom. And what's happening are people are going back, amending returns, and they're just buying elsewhere. We're seeing massive amounts of money fly out of the state into opportunity zones all around us. Pennsylvania, New Jersey, exploding. The development is amazing with the money that's funneling in there. Those are the types of changes that are giving investors great pause. You talked about self-storage. Self-storage was a great industry here, and our previous governor last year, in the budget, removed any tax abatement if you were self-storage. And
Wow.
real estate taxes, as you are well aware, if you're in a major city and you're dependent upon an ICAP, or you're dependent upon a 20-year significant mitigation of taxes, that's the inducement, right? People don't understand, why should they get a benefit? The reason they should get a benefit is because they're investing, in many cases, tens of millions of dollars to acquire the asset and to develop it. And when you took that inducement out, we saw a long, healthy pipeline of self-storage companies that were fixing to break ground and come to New York, and they just shut it off. It's a 20-year hit to your cash flow. Yep.
It's just so mind-boggling how they can change the rules on us just like that on property that is ours. And it's just, that's another conversation.
It's another conversation, but it's sound advice for those of you out there that are looking to invest. Make sure that you are looking at the local council, the local, whatever the governing entity is, where you're looking to make the investment and get a real good understanding of what the temperature is. Are they passing things like good cause eviction, which I think is disastrous, well intended, but disastrous ramifications? Are they passing legislation that's business friendly? And it's, when I started to do business out of New York City, Steffany, the first deal I had, it was a beautiful land deal in South Carolina. It was 316, I don't remember the units. It was several hundred units. And I was so programmed to the way we do business in New York that when we flew down to meet with the owners, after we had some negotiation through our intermediaries, we sat down for lunch and they literally began drafting a contract at the table. Now, where I come from, we retreat to our camp, you retreat to yours, and we start battling this, crazy.
Oh, the terms and conditions.
Several hundred page contract for a deal of that size, right?
Yeah.
We have shopping centers here, our leases, basic leases for a 2,000 square foot tenant. We just reviewed this in one of the deals that we're involved in. And somehow we ended up with an 89-page lease for a nail salon.
Oh, yeah.
89-page lease. And it's like, how does that even happen, right? So, you go in and you think, well, we can make this reasonable and we can cut this down to 10 pages for a non-corporate, non-credit, and there's just so many trip hazards. We trimmed it down to 28 or 29 pages, but still 30 pages for a nail salon. I don't know how we got here, but I do know, to get back to my story, that this is not how they do it elsewhere. And it was my first venture out of state, and I blew it, candidly, because as they started drafting language, literally with a pad and a pen, and we're sitting down over a meal, my antennas went up and I went, wait a minute, do you think you have the stupid New Yorker here that you're going to, there's something I'm missing with this site, right? Has to be that we couldn't possibly draw up a contract over a meal, right? Where are the attorneys and where's, all the trip hazards and searches? And I blew it because I was so programmed and I was so ready to fight. And I very quickly learned that there are really business friendly places out there. There are places where you can make these deals and perform exceptionally well. And it just doesn't have this high level of scrutiny. So again, I got off on a bit of a tangent there, but as some of the typologies you had mentioned, car washes, same thing, actually, as I'm thinking about it. They started to pass restrictions where you couldn't do it unless there were certain infrastructure elements that were there, and we started to see car washes disappear. So you're using good old-fashioned common sense. You're taking a look at what you're finding out on the websites, and you're kind of piecing this together. So I have not done many deals where we bought the real estate and bought the business. We have bought businesses separate. We have bought real estate separate. I'm curious if there's ever been a deal where you absolutely love the dirt, but you couldn't get through some of the nuance of the business and you had to pass.
Thankfully, not yet. But sometimes I do think of selling the car washes, honestly. But I am in the process of delegating as much as possible to people and creating, the whole infrastructure for me to have the least amount of work as possible. I just needed some time to learn the business and take phone calls and all of that, and really understand what's behind it and how I should program, the management from my end.
And when you're taking these pieces down, I assume the old owners stay on for a period of time?
Yeah, very good point too, which is definitely something that everybody, if they're thinking of buying a car wash, if you're local, have the owner at least available for 6 months. If you're not local, through a full, 4 seasons, if you're in a city with 4 seasons, because there's snow and there's other things that come into play that, you need to be aware of what to do. So yes, you should definitely put that in your contract.
And are you, sometimes the ledger doesn't quite match the cash register.
Mm-hmm.
Are you making provisions for any types of clawback, or are you escrowing a certain amount if in fact sales don't match? How are you managing that?
No, I did not. We just asked for the tax returns when we were doing our due diligence, and so far it's been matching.
Perfect.
Yeah.
Perfect. So, any other thoughts or tips that we could share with the audience if they're thinking about, getting in the game and taking down some deals, particularly deals where there's a living, thriving business attached to it? If you had to offer one piece of advice, what would it be?
Yeah, for new asset classes, go to a industry specific conference first before getting into that asset class. You meet so many people, you meet all the vendors, you figure out which vendor is the best. You'll be able to find mentors, people that you can call and say, hey, what about this? What about that? That is the one thing I did not do for the car washes that I would 100% recommend people do.
That is great advice. Any books that stand out that you've read recently that you think may be of value?
Oh my gosh, I'm blanking out on the name. There was one really good one for investments. If you can give me a second, I can find it, or we can just
Yeah. So,
something else.
no, what we'll do is, 'cause I don't mean to put you on the spot, but maybe offline, if you could shoot us a note, we'll
Yeah.
include it in the links below. I know that
Yep.
on the spot, there's so many books, the titles, the authors,
Yeah,
right? Everything seems
exactly.
to blur together. And how about any podcasts or anything that stand out, or is it just find something that's relevant in the industry and run it down that way?
I was listening to Joe Fairless in the beginning, and found my self-storage mentor through that. So it's you not only learn about multifamily if that's your thing, but I did find really good people there.
Great. So before I let you go, I'd like to get a sense of the other side of the guest. So, tell me a little bit about when you're not in real estate, right? What are some of your passions, some things you enjoy to do when you're not working 20 hours a day, I'm sure.
I am a big foodie by also just by living here where I live in San Francisco. So I love going out to eat at good restaurants around here, meet friends, meet family, go hiking. So
And
yeah.
how's the business doing out there? Are restaurants hanging in there? Are they doing okay?
Some did not survive, sadly, but a few of them did.
Yeah, we lost quite a few really great eateries
Oh,
out here also.
heartbreaking.
It is. There was no right answer when you go through difficult times like this. There's no right answer, and we don't like to um, look back and judge, but it did seem like there was an awful lot of wrong answers that seemed to be pretty apparent. So we're hoping that we're learning and we're headed in the right direction. We were talking with a restaurant operator maybe a week ago or 10 days ago, and they're really struggling. And this was
Mm,
a really successful restaurant. I won't mention the name, but they had said, James, it's so hard for me to sit down. And I was watching a football game. I think he had said it was the Las Vegas Raiders. And he had said, they had opened a new stadium and there was 50, 60, 70,000 people. And it's Vegas, right? So these are people from everywhere, right?
yeah,
And there wasn't a mask to be
yeah.
found. And I'm not advocating yes mask, no mask. I'm trying to convey the plight of a
Oh my
local
gosh.
business operator. And
Yeah.
he said, here I am, and I can't sell my product unless someone has basically a license to come in and patronize my establishment. Yet I'm watching in another state 70,000 people shoulder to shoulder,
Yeah.
screaming, yelling, cheering. And again, he wasn't advocating that
Yeah.
was right or wrong. His issue was the inequity and the imbalance. That's where the challenge lied. So look, these are tough times, but we do our best to figure it out. I love that you're supporting local restaurants. Again, folks, Steffany's got a great podcast, commercial real estate investing from A to Z. They're nice, to the point, 17, 18-minute to 20, 25-minute episodes. Great guests, packed with information. Steph, what's the best way for people to find you?
I mean, all the social media, LinkedIn, and everything else, or my website, montecarlorei.com.
All right, Steffany Boldrini, thank you so much for your time.
Thank you so much, James. Great interview.
Thank you. As always, everyone, stay safe.